Okay, final video for chapter 18, covering 18-16, where we're looking at sales and leaseback. We have Super Grocery Inc., who sold their major distribution facility that had a 22-year remaining life to an investment trust for $9 million cash. It had an original cost of $10.4 million and accumulated depreciation of $3.6. On the date of the sale, they signed a 20-year lease agreement leasing the property back. Annual payments are beginning on December 31st of 20X2 for $875,000. So that is actually at the end of the year rather than the beginning, like we've seen up to this point. They have an incremental borrowing rate of 9%. The implicit rate isn't known. They use straight line depreciation and have a December 31st year end. They take part year's depreciation depending on the date of acquisition, expected residual value, but it's not guaranteed, and we need to round to the nearest percentage. They are talking about when it comes to sales and leasebacks, and we need to look at the proportionate claim of both the seller and buyer when we are calculating the right of use asset. So we are going to look at that in just a minute. We need to give the journal entries they would make to record the sale and the lease, and then we're going to repeat everything, assuming that they have a repurchase option after 10 years. So starting off with our journal entries, I think the easiest way to do this is to go through the journal entry and all of the accounts that we use and calculate the amounts as we do it rather than before. So our very first entry is going to be January 1st. We're going to record the sale of the original asset, and then we are going to record the lease itself. So the very first thing that we can do is to record the cash that we're going to receive on the sale, right? We're selling this asset. We're receiving $9 million cash, which comes directly from the question. The next thing we can record when it comes to the sale is that we need to get rid of the original asset on our books, which includes getting rid of our accumulated depreciation. So accumulated depreciation is going to have a credit balance, which means to get rid of it, we are going to give it a debit. And in this case, it is for $3.6 million, again, given to us in the question. And we know that we're going to have a credit for the asset itself, which is the distribution center at its original cost, which was $10,400,000. Okay, so that records the sale. The next thing we're going to look at is establishing our right of use asset, and we need to do a calculation there. We would also record our related lease liability. Okay. And when it comes to sales and leasebacks, and when you're dealing with proportionate claims, in this case, we are going to have a gain on that sale or leaseback. If we had a loss, it would be a debit instead of a credit. So first, the next easiest thing to calculate is going to be the amount of our lease liability, which is going to be the present value of our payment cash flows. Okay. Our payments, we know from the question, are $875,000. That is not a percentage. So let's move this up one. And we will put our borrowing rate here, which is our incremental borrowing rate, since we don't know the implicit rate of the lease, but we know that it is a 9% incremental borrowing rate. And lastly, number of periods, we're dealing with a 20-year lease. Okay, so using our present value formula for 9%, period of 20 years, our payment. In this case, our payment is happening at the end rather than the beginning, so we're not going to include that 1. We can include a 0, but you can also just omit putting anything at the end, and it will return the appropriate present value. This is the amount of our lease liability. Okay. So the next thing we need to know is going to be our right of use asset. Okay, so the initial cost of our right of use asset. And to calculate this, we need to look at the seller's proportionate claim and the buyer's proportionate claim. Okay. The seller's proportionate claim comes from the original net value of the asset, and then is going to be divided by the amount of cash. No, I'm sorry. My brain is tired at this point. I was thinking of the final initial cost where we need the net book value. I'm sorry. The proportionate claim, we are taking the present value that we just calculated and dividing by the amount of cash that we are going to receive. That gives us a proportionate claim of 89%. The buyer's proportionate claim then is going to be the difference between 100% and the seller's claim. In this case, we don't need all these decimals, 11%. Okay. Now we're going to take our net book value. So we had an original cost of 10.4. We had accumulated depreciation of 3.6, which gives us a net book value of 6.8. When we multiply our net book value times our proportionate claim on the asset, the amount that we get is the initial cost of our right of use asset. Okay. The last part of our journal entry is the gain on the sale or leaseback. Of course, we could just take the difference between our debits or credits, but let's tie this all together and calculate that gain based on the buyer's proportionate claim. Okay. So for the buyer's proportionate claim, we want to take what they spent on the asset, which was $9 million, subtract out the net book value, which we just calculated at 6.8, and then multiply by 11%, which is going to give us an amount of $247,506. Okay. Or the difference between all of these. But that's not going to finish off our journal entries for 20X2 because we also have our year-end entries that we're going to need to make. Okay, we have 2 year-end entries that we need to take into consideration, which is going to be our interest expense and the impact on our lease liability. And then we're also going to have our depreciation. Okay, so the interest expense is going to be based off of our lease liability multiplied by the 9% incremental borrowing rate, giving us an amount, I don't know if it lets me do both, it does, $718,873. Okay. Next piece of this is going to be to record the depreciation. So our depreciation expense on the right of use distribution center and our accumulated depreciation. So what we need to look at here is that this asset has a 20-year useful life to us. Okay, even though it has a 22-year remaining life, we are leasing it for the next 20, and there doesn't look like there is an extension or a purchase that's going to happen in this requirement 1. So we are taking our 20 years. Okay, the residual value of $50,000 is not guaranteed, so it is not part of our calculation when it comes to depreciation. So we are not subtracting out that residual value. Next thing we look at is that they take a partial year depending on when it was acquired. Since this happened at the beginning of the year, we're going to take a full year of depreciation. Okay, so our right of use asset divided by the useful life to us of 20 years gives us an amount of 301,749, and we can get rid of our decimal. Okay, so that's to record the depreciation. Next, we can move on to requirement 2. We need to repeat everything we just did, but we're going to assume that Super Grocery has the option to repurchase the equipment 10 years after the start of the lease for an amount of $7,500,000. Okay, so requirement 2. We're going to start with our journal entry for January 1st of 20X2, which is going to record the initial sale. So requirement 2, what makes this different from requirement 1? Okay. This transaction is not considered a sale for the terms of sale and leaseback. Okay. And that's because the transfer of control has not occurred between the seller lessee to the buyer lessor. More specifically, given that there is an option for the lessee to repurchase the asset, control has not been transferred. So we don't account for it the same way that we do a sale and leaseback. So in this case, we treat this as a financial transaction. So we record the cash that we received for the asset, which was $9 million, and we're going to record a financial liability, okay, for the same amount. We are not writing off the original asset off of our books. We are not recording the lease agreement with the right of use asset and the lease liability. Okay, so the entry is actually much more straightforward. On December 31st, our original asset would be recorded kind of the same, would be recorded based on the original asset on our books. So really all we're looking at is our interest expense, the impact on our financial liability, which is going to be to slightly reduce, and then the cash payment that we're going to make. Okay, so we know that amount is $875,000. So in order to determine our interest expense, we require the implicit rate of the lease. Okay, so I'm actually going to give you this amount. This can be calculated using the present value formulas or the formulas from business math for the implicit rate. For our purposes, we don't actually require the ability to calculate implicit rates. It's not in our course outcomes, even though I know you guys have done it elsewhere. Okay, so if we take the $875,000 payment and we use the present value of an annuity factor, okay, we can, for a 20-year period, we can move backwards to calculate the implicit rate that's not known. In this case, it is 7.38%. Okay. So knowing that amount, our payment multiplied by that rate of 7.38 is going to give us not a percentage. Goodness. Sorry, guys. The original financial liability of $9 million multiplied by that rate gives us an amount of $664,200. Okay, so that is our interest expense. The $9 million times that implicit rate, which I've provided to you, but which you could calculate. It's not given in the question, but you do need it to calculate the interest expense. The financial impact of the financial liability, of course, is the difference between the cash payment and the interest expense, which means the principal amount is going to reduce by $210,800. So that brings us to the end of chapter 18. The quiz is on LMS. I will leave it open a few days longer than I normally would to account for the March break, and also check out the LMS for take-home assignment number 2.